You guys have been talking about this idea of bottoming processes happening and just the degree of magnitude for some of the moves on an intraday basis. You guys are absolutely right. The idea here is that the bigger the point moves are on a much bigger basis, say 7,329 for the Nasdaq, doesn't seem quite as big anymore. But we have been moving quite a bit off the highs that we've recently seen. For the Nasdaq Composite, almost in correction territory, or that is the term some traders use to describe a 10% pullback. We're at about like 9.7, 9.8% off those levels. So the Nasdaq one to watch there, and that's the reason why people are citing that as maybe the epicenter for a lot of the moves lower here. Also taking a look at some of the other hot spots that we're talking about macro market-wise from the large cap indices perspective. If you look at the Russell 2000, we are in correction territory right now, a pullback of greater than 10%. Again, that term used by some traders. So we're about 11% to the downside here. So that's the reason why small caps very much in focus. One other place to look at is just some of the at least the industry-specific side of things with regard to chips. That could be something that plays out within the S&P 500 because that's that 200-day moving average that was broken just yesterday. And again, this idea that you can move below a longer-term average for a major market index is something that has some traders a little bit worried. Remember, it doesn't happen all that often. We've kind of had just a couple times over the past year when we were flirting with that 200-day average. And one of the big divergences a lot of people are watching right now is the year-to-date performance of some of these sectors within the S&P. If you look just back again, month to date, the utilities and consumer discretionary, this gap here is the widest between any two sectors in the S&P. It tells you a little bit, Joe, about that whole defensive interest rate play for the utilities versus that more cyclical, economically sensitive play for the consumer discretionary retail stocks. That's a gap that we'll be watching in the coming days here as we start to see perhaps a bottoming process or perhaps an acceleration to the downside.
You know, that's interesting because I heard yesterday people talking about how they'd be buying up the utilities if they were really getting defensive. But the idea that they've maintained and stayed flat while everybody else dropped 10%, that's the same equivalent.
Well, and not just that. Remember, a lot has been made, and this is obviously subjective, and everyone's got their own kind of metric on this. But many people say that if the Dow was going to drop 1,300 to 1,400 points, you should have seen more than a 9, 10 basis point drop in yields on the 10-year U.S. government note, right? This idea that a flight to safety should have taken more hold and it should have played out a lot more aggressively in 10-year note yields. That's lending some of the experts to say that interest rates really are the focal point of this story, and that the idea that interest rates are on a path or trajectory higher is going to outweigh a lot of the other forces at play in the market overall.